Dear viewers, welcome to our channel GVS Bank Academy. Today I am going to discuss about JAIIB, Accounting and Financial Management for Bankers. As for new syllabus, this topic was introduced to capital structure and cost of capital. Module Accounts Module 3. Capital structure and cost of capital. Our JAIIB CAIIB promotional exam classes are going on. Interested members already for the May-June examinations, JAIIB and CAIIB batches are under progress. Interested members are requested to contact on this number. Now, capital structure and cost of capital. You are going to calculate weighted average cost of capital, WACC. What is meant by capital structure? Is referred to as on the proportion of debt and equity in the total long-term funds. In a company's balance sheet or any firm's balance sheet, what is equity and what is the long-term loans? That is called capital structure. Debt means long-term debt. Equity means net worth, capital, reserves, surplus, total. Cost of capital is equal. Cost capital structure के बाद cost of capital is equal cost of debt, long-term loans. Cost of preference share capital, how much dividend you are paying on preference share capital. Cost of capital, how much you are paying on capital. And cost of retained earnings. Retained earnings means surplus, profits retained in the business. Net worth, part of net worth. This is also important factor. So cost of capital is equal cost of long-term loans, cost of preference shares, cost of capital, and cost of retained earnings. Cost of debt means how much you are paying on the debt. Preference share capital means how much preference dividend every year you are paying on this. The capital structure of a firm is under as on 31st March 2022. Capital structure amount in crores. Equity share capital 8 crores. Equity share capital 8 crores. Preference share capital 2 crores. Debt capital long term loans 10 crores. Total capital structure is 20 crores. 8 crores capital, 2 crores preference share capital, debt capital 10, total 20. Out of 20, what is the weight of equity capital? We have to calculate weight. Equity capital weight 8 by 20. In the total capital, what is the weight of equity? 8 by 20 is equal to 0.40. 8 by 20 is equal to, you will get 0.4. 2 by 20, you will get 0.10. Weight in the capital. 10 by 20, that is exactly 50%, 0.50. So total weight is 1. Out of 1, equity capital share weight is 0.4, preference share capital is 0.1, debt capital is 0.5, total. What is the cost they are paying to equity capital? 14%. Preference share capital, every year they are paying dividend 12%. Debt capital, they are paying 10%. So what is the weighted average cost of capital? 14 into 0.4%. 0.4. 14 into 0.4, that is 5.6. 14 into 0.4. 12 into 0.1, 1.20. 10 into 0.5, 5. Now total, what is the weighted average cost of the capital structure in this company? 5.6 plus 1.2 plus 5.50. So total 11.8 is the average cost of capital in this firm. 11.8. This is one capital structure and cost of capital. Capital structure definition, cost of capital also we have discussed. This is problem number 1. Problem number 2, weighted average cost of capital. We have to source of capital, equity share capital, retained earnings means retained profits in the business, surpluses, reserves, retained earnings, preference share capital, and long-term loans. This is the cost. How much they are paying on equity share capital? 14%. Retained earnings also 14%. Preferential capital 10%. Long-term loan they are paying 8%. This is the cost of capital. What is the percentage of total capital weight as for book value? As for their balance sheet book value, weight of the equity share capital is 0.4%. Weight of the retained earnings in the total capital structure 0.1%. Preferential capital 0.15. And long-term loans payable after 1 year 0.45. Total weight if we can calculate 1. Total capital we are converting into 1, that is called weight as for book value. Now weighted average cost of capital is equal to weight 0.4 into 14% cost of capital, that is 5.6%. Again weight 0.1 into 14, 1.4%, 1.4. 0.15 into 10, 1.5. 0.45 into 8, 3.6. If we can calculate, that is 12.10. Weighted average cost of capital in this firm is 12.10. These values how we had derived book value. As for the outstanding amount of capital, retained earnings, preferential capital, long-term loans. As for book value, we have taken weighted average. We have taken. This is capital structure and cost of capital. This is problem number 3. Weighted average cost of capital based on market value. Earlier problem we had seen book value. Now this is market value weights. Market value of the debentures, market value of the shares we have taken. Accordingly, weights we have calculated. Then share capital 12% debentures. On the debenture they are paying 12%. How many debentures are there? 6,000. Face value is 1,000. Present market price is 110 rupees. So 6,000 into 110 market value. That is total market value of debentures 6,60,000. Face value is, book value is 6 lakhs. Market value is 6,60,000. Whereas 4,500 equity shares. Face value is 100 rupees. Present market value 180. So 4,800 into 180. That is market value of the equity shares 8,10,000. What is the book value? 4,500 into 10. 100. 4,50,000. But in this case, we are taking market value weights. What is the total market value of debentures and equity? 6,60,000 plus 8,10,000. 14,17,000. 70,000. Now, 6,60,000 divided by 14,70,000. The weight approximately it is coming 0.45. 8,10,000 divided by 14,70,000. That is coming around 0.55 weight. So total weight, weighted average cost of 1. We have taken 1. Now, after tax cost of capital. Now, this company paying tax, income tax 25%. On 12% they are paying. Out of 12% they are getting 25% tax benefit. 12 minus 25 means 3. So actual cost is 9. 12 into 1 minus tax rate, that is equal to 0.75. 12 into 0.75, 9. After tax cost capital is 9%. How? Once again. 12 actual cost. 25% means 1/4 they are getting tax rate 3%. So 12 minus 3, 9. Another way, 12 into 1 minus tax rate 0.25. So you will get 0.75. 12 into 0.75, that is equal to 9%. And equity share capital directly they had given 18%. After tax cost of equity 18%. Now what is the weight? 0.45 into 9. Average tax cost of capital, that is 9 into 0.45 weight, that is 4.05. Equity cost of, after tax cost of equity 18 into weight 0.55, that is around 9.9. What is the weighted average cost of capital at the rate of market values, not book value? 13.95%. 13.95. Here book value we have not taken. Market value we have taken. Earlier problem we have taken book value. In this case market value. What is the market value of debenture? 110. Face value is 100. book value, market value 100. 6,000 into 110 market value this. Same manner, 4,500 equity shares, each share 180. 4,500 180, 8 lakh 10. So, market value of the capital and debt 14 lakh 70,000. Accordingly, weights you had calculated. For the debentures, for after tax cost also we had calculated. How? 1 minus tax rate, 1 minus 0.25, that is called 0.75. 12 into 0.75, 9%. 9 into 0.45, 4.05, 18 into this. This is the weighted average cost of capital. This is the new topic introduced in the JAIIB. The same topic may also useful for CAIIB, paper number 3, and also useful for promotion examination also. Thank you very much, viewers, for extending support to our channel. Thank you very much for all.